Welcome. This class is an intro to personal financial statements. The next couple of videos we're going to be focusing on are tools for financial planning. Personal financial statements are just one of the few tools that can be utilized to project your wealth over a given period of time. The first financial statement chart that we're going to be focusing on is the cash flow statements. A cash flow statement in this context of personal finance is measuring the cash inflows and outflows of a person. A cash inflow for most will be salaries. Other forms of income could be government assistance, social security, interest income from savings, or dividend income from investments. Cash outflows represents all expenses incurred. Our measurement is often looked at on a month-to-month basis. This is an example of a cash flow chart. It's also the beginning of a budget as well. If you can see, looking the cash inflows, which would be under income, salary, $8,333 for the month, less 401k, which is an investment plan or a retirement savings account, taxes and FICA, Social Security, Medicare, Medicaid expenses, less medical, dental, disability, and life insurance. It's also an expense that's removed. So the total income or the total cash flow for that month of January would be $5,141. Non-discretionary and discretionary expenses would be the total outflows of this particular statement. If you look down at the bottom, you can see that long-term savings and short-term savings alike would be considered as expensive for this particular chart, which is why the net cash flow would be zero. Doesn't mean that this particular individual has not saved anything. It just means, according to this context, they have infused savings as being incurred as an expense. When I said that this is the beginning of a budget as well, what a budget does, which you'll see in succeeding slides, it's comparing the plan for January and the actual numbers for January. And these numbers are identical, meaning that this person has stuck to the plan 100%. What affects cash inflows? 1. Job type. The more specialized the job is considered, the more money one would receive in income. Specialization is often correlated with more education, so the idea is the more education, the higher the income. There are cases, however, where specialization is not correlated with higher education. A few professions would be plumbers, electricians, entrepreneurs, to name a few. Another variable that affects cash flows would be the income earners, the number of income earners per household. Is it the mother, the father, the children working, earning incomes collectively, bringing in as a cohesive unit? The length of your career, it's generally correlated with the beginning of the year or the beginning of your career. You're making a lot less than as you advance further in your career, 15, 20, 30 years in the future. Another variable that affects your cash inflows would be the area in the world in which you live. Obviously, if you're in Trinidad, you're using TT dollars. If you're in America, you're using US dollars. If you're in Australia, you're using Australian dollars. What affects the cash outflows? One variable is the size of your family. The larger the family, the more spending, but even deeper than that is the dynamic of the family. An example is two parents, three babies, two parents, three teenagers, one parent, four college students, etc., so on and so forth. Another variable is your personal spending behavior. Are you a bigger saver or are you a bigger spender? How often do you spend? Do you spend excessively? Another variable is the age. Generally, there is a correlation between age and income. The older you are, the more into one's career and the more likely they are receiving a higher income. Another financial statement to look at is a budget. A budget is a forecast of future cash flows of a given time period. Let's say you're anticipating a bigger purchase in a couple of months. The utilization of a budget would allow you to plan ahead of time to make these big purchases. In later classes, we'll discuss how you can affect that budgeting with cash or credit. Again, that's in a course based on managing liquidity, and we'll talk about that later on. It's important to assess your forecasts periodically with actual numbers, like we saw in the cash flow statement previously when you had anticipated plan and actual numbers. Um, Unfiltered optimism can be harmful to your financial planning long term. Say, for instance, that you keep missing the mark by $300 or $400, but you're not looking at the actual numbers and you're only looking at your planning numbers. After a while, you can fall behind on your bills, your credit cards. It can get messy. Uh, Forecasting over several months to a year. Um, Most of us know when it's time to get breaks, oil change, tune-ups, or holidays approaching. Forecasting allows you to anticipate these events or these changes in your ordinary monthly financial planning. And to be able to anticipate them months in advance really does allow you to control the situation when the time presents itself that you need to make those purchases that aren't typical monthly purchases. Uh, Budgeting over a longer period of time, say for a year, also allows you to anticipate changes in income, vast or minor, to adjust your savings and expenditures accordingly. What that means is, let's say this is your first year in the job. At the end of a second year, you anticipate a $2 raise. You can start to incorporate that type of information into your forecasting and budgeting over the course of a year so that you can really make a difference or really take into account what needs to be taken into account to really control what's going on over the next couple of years. Uh, Here's an example of it's a cash flow chart in essence, but what it has, which makes it a budget sheet, is it's actually now anticipating months into the future. So instead of having just month one, it has month two and month three as well, which takes into account the forecasting aspect of it.